Welcome to TalkTickers. This is our deep dive into Everest Construction Group's Q1 2025 earnings call.
That's right. We're here to basically cut through the jargon and pull out the key operational and financial takeaways.
Yeah, specifically for you, the experienced investor who needs the core insights fast. Pretty striking numbers. Everest kicked off the year strong, really significant momentum.
That top line really popped. Total revenue surged 32% year over year, came in at $826.6 million.
And crucially, profitability kept pace, right?
Exactly. Total EBITDA also up 32%, hit $61.8 million.
Which means they held that margin steady at 7.5%, same as last year.
And that's even with those, extra standalone operating costs they flagged were coming.
Okay, but the number that really jumped out, at least to me, was the backlog.
Oh, yeah. Huge growth there. Total backlog, end of Q1, up 41% year over year.
And 10% just from the previous quarter.
Pushing it up to $3.1 billion. That's some serious visibility.
It absolutely is. So strong start, solid execution. But that backlog, wow.
Definitely paints a picture of future potential, even with, the kind of uneven market conditions they talked about.
Okay, let's break those numbers down a bit more. Segment performance tells a story.
Right. Where's the growth coming from? Mostly E&M, that's electrical and mechanical.
Yeah, E&M revenue jumped, 47%? Massive, to $648.2 million.
Huge driver. On the flip side, T&D transmission and distribution revenue dipped slightly, down 2% to $185 million.
They mentioned some weather delays there, right? Affecting utility work.
Yeah, early in the quarter. Though they said some transportation project work helped offset that a bit.
But here's the interesting part. Even with T&D revenue down slightly, the profitability actually improved there.
Exactly. So E&M EBITDA grew strongly, up 51% to $49.5 million, margin up 20 basis points to 7.6%. Pretty solid.
But T&D EBITDA was up 5.8% to $20.1 million, and its margin jumped 80 basis points to 10.9%.
That T&D margin expansion is really worth noting. How'd they do that with lower revenue?
They pointed to strong project execution and lower SG&A costs.
So efficiency gains, getting more profitable on the work they did do, that's good management.
Meanwhile, those standalone operating costs are tracking where expected, right? Towards that $28 million full-year incremental number.
Yeah, no surprises there. Seems under control.
Okay, let's shift from the P&L balance sheet. How are they looking?
Pretty healthy. Ended Q1 with $54.3 million in cash. Gross debt at $296.2 million.
So what's that mean for leverage?
Translates to about 1.0x net leverage based on trailing 12-month EBITDA.
1 times net leverage seems pretty comfortable, doesn't it? Especially for this sector.
Yeah, gives them flexibility, especially with the investments they're making.
Speaking of investments, CapEx saw a big jump this quarter.
It did. Q1 CapEx hit $18.5 million. That's almost double the $9.2 million last year.
So what's behind that increase?
It directly ties into their strategy. They're ramping up investments to support organic growth.
Like that new prefab facility.
Exactly. The big one was buying that 128,000 square foot prefab facility in Kansas City. Plus, ongoing investments in vehicles, equipment.
So it's strategic spending, not just keeping the lights on, aimed at future capacity, efficiency.
Precisely. Which fits right into their management commentary and their whole forever strategy.
Right. Those pillars.
Yeah.
Talent, they mentioned, adding skilled labor.
Attracting and retaining talent.
Creating value, safe and high quality execution, and customer relationships. Standard stuff, but sounds like they're focused.
And they also talk quite a bit about navigating, the current environment. Tariffs, trade uncertainties.
What's their approach, their Everest playbook?
Yeah, they called it that.
Yeah.
It involves lots of communication with customers, getting ahead of material procurement.
Locking in pricing where they can.
Right, and really focusing on favorable contract terms to manage risk, especially on fixed price jobs, trying to protect those margins.
Makes sense. And discipline in capital allocation wasn't just talk either.
No, they explicitly linked that CapEx jump, the prefab facility.
And hiring Timus as VP of Corporate Development and Strategy.
Right. They linked all that to building out their M&A capability, looking beyond just organic growth.
And this Timus guy sounds like a targeted hire. 20 plus years in construction services, banking, focused on E&M and T&D.
Definitely signals they're serious about M&A as another growth lever. Which is interesting, given how strong the organic backlog is.
On that backlog, they did add a small caveat, didn't they, about timing?
Yeah, just that the conversion, turning backlog into revenue, might take a bit longer than maybe historical patterns suggest.
Why is that? Just the project mix.
Exactly. They've got a higher proportion of larger multi-year projects in there now, so it stretches out naturally.
And they also mentioned non-backlog work, like MSAs is still important, but resources are really focused on delivering that huge backlog right now.
Makes sense. You got to execute on what you've already won.
Okay, let's shift again. End markets. Macro trends. What are they seeing for the rest of 2025? Sounded pretty positive overall.
Yeah, definitely bullish on key secular trends. Data centers, obviously, still a massive driver.
Seeing strong demand continue there? No slowdown from customers?
Nope. They said no meaningful change in customer build plans or timelines noted on their end. They feel well positioned with their expertise.
Hospitality was another one they flagged. Said they're seeing continued growth opportunities.
Mentioned some recent project wins in Las Vegas specifically.
And the high-tech reshoring trend. Still going strong.
Yeah, momentum continues there. They highlighted a long-standing, like 30-plus year relationship with a big semiconductor manufacturer.
Acknowledging it can be cyclical, but emphasizing their role in complex factory work.
Right. And they also called out pharmaceutical manufacturing as another focus area for growth, aligning both organic and potential M&A efforts there.
What about the T&D segment outlook, despite the Q1 weather hit?
Still confident. They see strong underlying demand for both undergrounding and overhead utility work.
Mentioned renewing key MSAs. Plenty of opportunities ahead.
And they specifically highlighted their expertise in complex undergrounding. Gave an example of work in Southern California wildfire areas, like the Palisades. Ties into that whole grid hardening, infrastructure resilience theme.
Important work. Now, they did mention one thing about Q1,
Yeah.
some revenue pull forward.
Yeah, a bit of Q2 revenue landed in Q1, which helped boost the numbers. They cautioned, it's early in the year, macro uncertainty still exists.
So quarterly timing can be lumpy. Standard disclaimer, really.
Pretty much.
Yeah.
But they reiterated their confidence in managing risks like tariffs through that proactive procurement and contracting. They feel they've mitigated potential margin hits.
Okay, and the bottom line for the year. Guidance.
They are affirming the full year 2025 guidance range, holding steady.
Remind us of those numbers.
Revenues between $3 billion and $3.1 billion. And EBITDA between $210 million and $225 million.
And they're sticking with that based on the strong Q1, the huge backlog, those demand drivers.
But also acknowledging, yes, it's early. Things can shift. They also mentioned that long-term financial framework again.
Right, aspiring to that 5-7% compound annual organic revenue growth.
And 7-9% compound annual EBITDA growth.
Yeah.
Driven by that forever strategy.
Okay, so let's try to connect the dots here for you, the listener. How does this all fit together in the broader construction services picture?
Well, it certainly feels like Everest is hitting some key themes, doesn't it?
Yeah, that strength in data centers, high-tech reshoring, grid resilience work like undergrounding. These are big infrastructure investment narratives right now.
They seem well positioned in those specific high-growth niches.
And the focus on capital allocation, investing in prefab, bringing in M&A expertise. What does that signal to you?
Signals confidence, I think. Confidence not just in executing what they have, but in actively pursuing future growth, both organically and maybe through deals. They seem serious about hitting those long-term growth targets they put out there.
And in this environment, execution is everything, right? Managing the risks, whether it's tariffs, project schedules, labor.
Absolutely. Their commentary suggests they believe they have the systems, the playbook, as they call it, to handle these things. And they're investing to get better at it.
They also mentioned upcoming investor events, so opportunities for you to engage directly if you follow them closely.
Okay, now for our favorite part, the not financial advice segment.
Definitely not financial advice. This is purely a thought experiment. An outrageous but plausible trade idea based on what we just discussed.
Just something to consider, to mull over.
All right, so here's one. You look at that massive 41% backlog growth, right? Heavily weighted to these really strong secular trends, data centers, reshoring. You see management executing well, even improving margins in T&D despite lower revenue.
And you hear them talking about managing risks like tariffs proactively with their playbook.
So the plausible part, maybe you consider a really convicted long position.
The balance sheet supports it, right? 1x net leverage offers flexibility. Those strategic investments in prefab and M&A leadership show they're playing offense for future growth.
And the affirmed guidance, even if maybe a bit conservative sounding, given the macro, it's backed by huge backlog visibility.
Okay, now lean into the outrageous part.
What if the market is just fundamentally underestimating how long and how strong these data center and reshoring waves will be? Or maybe it's putting too much of a discount on general macro fears that Everest, with its specific niche focus and demonstrated execution, can actually navigate better than average.
So the outrageous idea is, you could argue for a price target significantly higher than where it is now, based on the idea that they can maybe even beat that 7-9% long-term EBITDA growth target, given their positioning and execution.
It's basically a bet, isn't it? A bet that their focused execution in these booming niches will override the broader economic static.
Again, just a thought experiment, definitely not advice. Do your own homework.
Okay, so let's wrap this deep dive up. Quick recap.
Everest Construction Group, strong Q1, big revenue and EBITDA growth.
Driven by that huge backlog expansion, especially in E&M markets like data centers.
Management seems to be executing well on their strategy, making targeted investments, managing risks.
They affirmed their full-year guidance, backed by that backlog in demand, and pointed to their long-term growth framework.
And just to reiterate, this was our impartial summary of the call, not financial advice in any way.
So here's a final thought for you to take away. As you process this, think about those specific secular trends, data centers, reshoring, infrastructure resilience like undergrounding. How are these powerful forces impacting other companies or sectors you follow?
Yeah, and consider how the specific demands of these types of projects, the complexity, the scale, the risk profiles, might be changing the game for operational execution across the entire construction and engineering industry. Something to chew on.